Well, hello, welcome to FX Master Legging in Strategy. This is Robb Reinhold, and this might be my absolute favorite thing to talk about. It really might be, and I'm not just saying that to make this more exciting. This is just a really cool strategy, and I've got to say that I have thought about how in the world we can use this strategy in our other options trading division, and I just can't figure it out. I don't think it's possible to do it with options, but it is absolutely possible to do with Forex, and not just possible, but it's amazing when the market is correct. So let's really kind of start off with going all the way to the reason we build a trading plan, the reason we do systematic trading. It's high probability trading. Now, basically what this is saying is we want to only trade when there's a good setup. And we only want to use a certain strategy when the market says this is the right time for the strategy. So high probability trading basically says don't put your money into the market unless there's a great opportunity. If there's not, stay out of the market. One of the most difficult things, at least for me to learn as a new trader, was how to stay out of the market. I wanted to trade. I wanted to click buttons. I wanted to be active. I wanted to feel like I was working and doing stuff. And I realized that that was forcing me to make a lot of trades that I really shouldn't have made because they didn't have a good enough risk reward and they didn't have a good enough setup. So as a trader, your job is to focus on putting your capital into a trade only when everything lines up. Not when something's lined up, not because you're bored, not because you haven't made a trade in 2 days. None of that matters. You should only be trading for the sake of trading is what I always say. And what I mean with that is that you should only make a trade because it's a great setup. It shouldn't be a trade because you have to make $1,000 this week. It shouldn't be a trade because, it's, like I said, you were bored and need to do something. The trade should only be made if everything comes together. Basically, we do all of our charting, we do all our risk reward, we do our targeting. Everything we do is to put our capital in a situation that is has some odds in it. That's everything we do as a trader. So this strategy we're going to talk about today is basically really fits in within that idea that we're going to put capital on the line. And here's a great thing about the strategy is once it goes our way, we're going to put more capital on the line. Now, it's actually a really cool management strategy, and we're going to talk about it. But the very first rule of trading is to protect your capital. And hopefully every one of you has heard I call it my 10 trade analogy. And basically, it's where you're going to make your next 10 trades. Now here's the irony about those 10 trades. You're going to go in, you're going to do some research, you're going to look at charts, you're going to study up on whatever it is you study up on, and the only trades you're going to end up making are the ones that you're absolutely convinced are going to go in your favor. Think about it. You would never make a trade that you thought, oh, this one's going to go against me. You would never make that trade. So you end up only making the trades that you truly believe in or that fit your strategy. Here's the problem, is that not all 10 are going to do what you think they're going to do. And in my 10 trade analogy, I talk about half of them are going to go up a little bit, down a little bit. 1 or 2 are going to go really against you. Even though you did all your research, even though you did all your studying, they're just going to go bad. And then you're going to get 1 or 2 that go for you and go for you well past you even thought they could go. And I always love to draw the bell curve risk graph. And this is just statistics. It's that whenever you do a large sample size, you're going to get results that are, most of the results are going to be in the middle. But then you're going to get your outliers. This is going to happen to every single trader, is that most of the trades we make, they're going to be decent winners, decent losers, but we're going to get that handful that are absolutely huge winners, and we're going to get those that are absolutely the worst trades that you've ever made. You are going to get that distribution. So I really want to focus on the far right of the bell curve, because this is where the strategy we're going to talk about really comes into play. And it really is a capital allocation strategy. And we really always talk about, okay, put your money out there in the market when it makes sense and control and manage your risk. So again, the whole thing about trading, and a lot of people think trading is like gambling. And yes, it is gambling, but it's very, very planned. You should only make trades when it all makes sense. All right, well, let's start off with some psychology. Basically, we are all wired to lose. We're all wired to lose in trading. Now, the reason why that is because we want to make money and we don't want to lose money. Now, look, that makes sense. Every single one of us went into this business with the idea that, hey, I want to trade to make some money. And I don't want to lose money. I really don't like losing money. When we go in with that mentality, let me tell you what's going to happen. And I'm going to use a stock example just because it's a little bit more simple. But someone buys a stock at 20. It goes up to 21. Then it goes up to 22. And it looks like it's going to turn around and come back down to 20. So they sell it at 22. They make a 10% return. Yes, that is the whole point of trading. We did it. We bought the stock at the right time. It went up to 22. We sold it. We locked in a 10% gain. That makes us feel good. That makes us feel, oh, that's good. I made money and I didn't lose money. Well, the next trade that they take, they buy another stock at 20. This one goes down to 19. And then when it goes down to 18, they're looking at this where they should get out. They're saying, well, if I sell here at 18, I'm back to where I started. I'm back to break even, and I want to be a winner. I don't want to be a loser, so I just need to give it some more time. So it goes to 17, 16, it goes down to 15. Now at 15, now they're thinking, uh-oh, this is worse than I thought. Now I'm at a loss. If this could just bounce up to 18 where I could break even, I'll get out at 18. I'll go back to break even. Remember how break even wasn't good enough to get out the first time it crossed 18? They think, look, if it just goes back up to 18, that's where I'll get out, and we'll start over. Well, it doesn't bounce to 18. It goes to 13, 12, 11, and pretty soon this thing goes down to $6. And you can see at this point, you say, well, I can't sell it here. It's already gone down so much. It's not worth selling, or it's got to come back up. And you end up being stuck with losers. Meanwhile, the first stock that you bought at 20 and sold at 22, this one's at 35. So one of the things we talk about, and hopefully you've heard about this, but there's a study that FXCM did. FXCM is the biggest retail broker in the world for FX, and they took all the trades that their clients made over a year's period, and they did statistics on it. Now they found that 59% of all the trades that the traders made were winning trades. Think about that. Their traders had a 59% win-loss ratio. However, only 6% of their accounts made any money. How is that possible? How in the world can you take all these accounts where 59% of all trades made were winners, but only 6% of the accounts made any money? Well, you go over here to their reward to risk ratio, and I think the average gain was about 59 pips, and the average loss was 118. So you could see that this study showed that amateur traders, for the most part, are pretty good at picking trades. They're pretty good at picking winners over losers. What they're not good at is the management, and that's exactly what we talked about over here, was the management of a trade. We want to hold our winners and sell our losers. And in this strategy, we want to add to our winners. So imagine if this trader got out of their loser at 18, bought more of their winner at 22, bought more at 25, bought more at 28. The results would be dramatically different. This trader would have made a ton of money, and this trader basically lost all their money. That is what the strategy is all about. It's all about maximizing the winners and cutting the losers. So as we go through the strategy, you'll notice that I'm always going to be talking about maximizing our winners, but we're going to be controlling and managing the risk the entire time. It's really cool. I love this. All right, before we get into the strategy, I want to kind of go over my craps strategy with you. Now look, we definitely don't want to spend much time on craps. I'm not going to teach you how to play craps. It's a game in Vegas. But craps actually has the highest odds of any table game you can play in Vegas. If you play the right strategy, I believe it is a 49.8% win-loss is what you get. It's the closest you can get to break even in Vegas. Now again, you've got to have a high odds table, which I haven't seen one of those in a while, but you can pretty much get to break even using this strategy. And what the strategy is you place a bet on what's called the come line. Now the come line basically says, okay, so let me go back. So the first roll, someone rolled a 4. Okay, someone rolled a 4, so that's now called the point. So if you place a bet on the come line, if that person hits a 4, you win. Let's say the next roll is a 5. Well, what they do is they take your money from the come line and they now put it on the number 5. Now what they allow you to do is they now allow you to back it up with odds. Now this is where craps really gives you better odds, is that they allow you to put up to $5 behind $1 of a chip. And that's going to get you odds. And if you hit that 5, sorry, it really should be $6, they're going to pay you 8. They're going to pay you $8 on your bet of 6. Let's say you place another bet on the come line and it rolls a 10. They're going to move your bet to the 10, and you can back up this one chip with $5. And this $5, if it hits a 10, it's going to pay you $10. So as you can see here, we're actually making more money based off the strategy, and we're backing it up with odds. So we're adding to our bets as the rolls go on. Now my strategy is I start out with $20. I put on the come line, I back it up with all the odds, and I wait until I win at least $20. Once I win $20, I put it back in my pocket. Now in the game of craps, if somebody rolls a 7, that's called craps, and they take all the chips off the board. So as long as someone doesn't roll a 7, I'm going to be making money. And if I place these bets on the come line, I'm going to have all the points, all the numbers. I'm going to have bets on all the numbers, and I'm going to have odds behind them. And what happens is, once I get $20 back, what do? I start to press my bets. So every time I win $8, I'll press my bet by 5. So I'll put $3 in my pocket, and I'll put $5 back on the table. I'll bump up my odds on the 10 to $10. Now when the player rolls 10, I get $20 because the odds are 2 to 1. And again, that money goes to press other bets. I put $5 in my pocket, and then I press these with another $5. Now, of course, at some point, there's going to be a 7 that's rolled. I might have made, I might have made 30, 40 bucks on that roll. And then the next roll comes along, and guess what happens? I lose. I lose my 20 bucks. It was a bad roll. First roll after the point was a 7. I lose 20 bucks. Now what happens is eventually, if I can stay alive long enough, there will be somebody that rolls 30 rolls before they roll a 7. And if they are doing 30 rolls before you roll 7, you really build up some big chips on the table. And I've actually had games where I have had $200, which was the table limit. I've had $200 on all of the numbers, and every time a number hit, it would pay me either $400, $300, or $250. That's only happened to me a couple times that I've been able to build up to that much. But that is really the gist of this strategy. I started off small. I added to my bets. But once I got profits, I put them in my pocket to where I had my money back. and then I basically bet a percentage of my future winnings to basically boost the size of my bets. That is exactly what we're doing with legging in. So this only is going to work when you think there's going to be a large sustained move. So whenever the market is more volatile, I do much more pyramiding or legging in. You're going to hear me call it either pyramid or legging in. So the more volatile the market is, the more I will use this. The less volatile the market is, the less I will use this. Because again, we need large moves. Just like in the craps analogy, that strategy doesn't work so well if there's only 5 rolls before someone craps out. Now I think the average is 7 rolls before someone craps out. I think I remember reading that somewhere. So if the roll is only 5, it's not that good of a strategy. I'm going to put out all this money to build up this board, and then someone's going to roll a 7 after their 5th roll, and I'm going to lose probably 15 bucks. I understand that. But what I understand is when I do get that roll that keeps going, or in the market, I get that trend that keeps going, and I'm constantly adding capital into the trade, that's when you want to use this strategy. So please don't think that you can use this strategy all the time. The strategy is actually pretty lousy in low volatility environments, but in big volatility, this is the best strategy in Forex in my opinion. The best strategy, totally. All right, so, wow, I already gave you my craps analogy on a much smaller craps board. But again, the whole idea is we're going to be building a trade. We're going to be building a trade. We're going to come with our come out bet. We're either going to win that or lose that. If we win that, we're going to add some capital to it. If we win that, we're going to add some more capital to it. And basically, we're going to be building and putting out more capital. And the whole time, we're putting some money in our pocket. We're locking up our first, let's say we made a $20 bet. Once we make 20 bucks, we're going to put that in our pocket. Then we're going to put out some more money. And then we're going to put some more in our pocket. And then we're going to put out some more money. And at some point, the roller will roll a 7 or the market will change. You'll get knocked out of your trade and you're going to have a large return. All right, so let's go into the strategy. All right, so let's take the FX high base. Now again, this is a simplified strategy sheet here, but basically you've got your high base. Your high base is a currency pair, has a run up, and is traded sideways for a period of time, and then it breaks out to the upside. We love this strategy. It's a great strategy. And the trigger is when it breaks out above the resistance line. But once it breaks out of the resistance level, that is the trigger. That's time to go in and take your position. All right, so let's talk about the legging in position, because there's 2 different ways I want to talk with you about how to do it. All right, one of the ways you'll see us trade and using this strategy quite a bit is before a news event. You will see that we will sometimes take a half a position, or we'll take a third of a position. We just did a trade the other week where we took a third of a position before the news announcement. The news announcement came and go. It didn't really go anywhere, and we dumped our third of a position by the end of the day because it wasn't moving. So let's break down the numbers. So if you are doing this larger initial stop, so basically what it's saying is I want to get into a position. I'm going to take a half position, a third of a position. I'm going to take a smaller percentage of what I want my full position to be because I want to be able to have a larger initial stop. So let's go through this just so you understand it, because again, there are different ways to do this legging in. So let's say that there's a currency pair at 110.50. All right, and let's say that 110.50, this is where resistance is. It's come up, it's high based, and it just broke out. Okay, so this is our trigger here. We want to buy it on the breakout of 110.50. But let's say there's a news announcement coming in, or there's a lot of volatility. And we want to start off with a wider stop. Because on a full position size, let's say your full position size is $100,000 worth of the currency, or one lot. And let's say your original trade would have been, I'm going to buy $100,000 and I'm going to have my stop down here at 110.20. All right, so again, you've determined I'm going to take 30 pips of risk. I'm going to buy one lot. That means I have $300 at risk on this trade. Again, 30 pips of risk times $100,000, that's $300. So that would be the normal trade you took. But let's say that you were going to expect some volatility. So the legging in trade would be, I'm going to take 50,000 of my position at first. I'm going to take a half a position, and I'm going to take double the size of the stop. So my stop is going to be all the way down here to 109.90. So basically, we now, instead of having a 30 pip stop from where we got in to where we get stopped out, we're now going to have a 60 pip stop. So because we have a stop so far away, the odds of us getting stopped out are actually much lower. So what this allows you to do is allows you to get into a trade. And again, we like to use this before sometimes a news report, because we want to have a large cushion. We want to have a large stop to where all the choppy movement we see after earnings doesn't knock us out. And then what you'll do is you'll predetermine where you're going to take your second position. So let's say that we've predetermined that we're going to take another 50,000 position, and we're going to take that at 110.70. So again, you can set this all up automatically. Say, hey, I want to buy another 50,000 at 110.70. So if this does keep going, the trade keeps going your way, and you get filled, you will have a 100,000 position exactly how you wanted originally, but your average cost is now going to be 110.60. So if you just bought it all at 110.50, that would have been your cost basis. Because we did two entries, one at 110.50 and one at 110.70, we now have average cost of 101.60. Now we have to continue to follow our risk parameters, our rules. Our rule was we don't want to lose any more than $300 on this position. So if we look at this trade here on a 100,000 position, that's 30 pips. So we will need to adjust our stop to be 30 pips under our average price. And that is going to be still maintaining a $300 loss. All right, so hopefully everyone understands the first way to do it. You can take a third of a position. I'm going to get into 33,000, or I would probably start off at 34,000 on the first one, add 33,000, add another 33,000 to get into a full position that I want. All right, again, this is a great strategy going into earnings. This is a great, not earnings, but into news announcements, because what it allows you to do, it allows you to have a much wider stop. You are much less likely to get stopped out on a 60 pip. Now, if you did a third of a position, you'd have a 90 pip stop. You'd be all the way down here at 109.60. That would be 90 pips away. You're going to have to be really wrong on that trade to be knocked out. You won't get knocked out with volatility. So it's a great way to get into trades and allow the trade to move around a lot if it's volatile. All right, the other way I wanted to talk about, and this is really the exciting way, is that you will take your full position size and then you'll add more as it goes your way. So let's go back to that example of the trade at 110.50. It's a high base, so we say, you know, I don't know why I'm starting this up so high. I should start it down lower. We've got the high base pattern. It's come up here. Resistance is at 110.50. So we want to take a position. We want to buy when it breaks above 110.50, and it does. So we're going to take our full position. We're going to take 100,000 as our full position. We've already predetermined we're going to have a 30 pip stop. So our stop is going to be down here at 110.20. That is $300 worth of risk. And we call this a 1x position. All right, so this is our full position size. We want a full position size of 100,000. Now, if it goes against you, you're going to get stopped out at 110.20, and you're going to lose 300 bucks. That's just what happens sometimes. But you're expecting this to have a pretty good size move. So you're going to predetermine, I'm going to buy another 100,000 when it gets up to 110, let's use 110.70 again. So once it goes up and hits 110.70, you now have a 2x position. You have 200,000 at an average cost of 110.60. Now again, you need to maintain your $300 risk limit. So you now have a 2 times position. So a 1 time position was a 30 pip stop. A 2 times position will actually be a 15 pip stop. So you're going to need to move and adjust your stop to 110.45. That will maintain that this is only going to be a $300 loss. But here's the cool thing. As you can see, we now have double the position size. So if this thing runs up to 111, instead of making 500 bucks, we made 1,000 bucks. Now, of course, at some point we want to get up to break even. So again, you'll have your rules. At some point, you're going to move your stop up to break even at 110.60. And if you wanted to, if you still like the trade, you could take another 100,000 position up at 111. That's going to be a 3x position. And again, you're going to adjust your stop. So in a 3x position, that stop's going to be 10. It's going to be only a 10 pip stop from your average cost. Or maybe you decide to move it up to break even. But you can see that, yes, sometimes these will fail, and they'll come back down, and you'll break even. You'll make a little bit. You'll lose a little bit. That's okay, because remember, there's 1 out of 10. There's maybe 2 out of 10 trades that you're going to get into that's going to keep going and go up to 112. Now, if it goes all the way up to 112 on a 3x position, that is going to be probably about 4,000 bucks. About 4,000 bucks on a trade that had $300 at risk originally. Again, I wish they would all keep running. I know I love it when they run and I can pyramid into it. I love it. But at Maverick, we have a saying, trade the market in front of you. You have to trade what the market's giving you. Like sometimes in the summer months can be less volatile. There's not as much movement. You don't want to be doing pyramiding. But somewhere during the year, there's going to be a lot of activity, and pyramiding is a fantastic, fantastic strategy. All right, so let's run through with some charts. So here we have our high base pattern, and we took our first entry at 92.35. Now you can see on this simplified sheet here, we've got trade stage entries. So again, 2 trade stage entries. You're going to basically predetermine my first entry is going to be at 92.35. And then my second one is going to be at 92.50, or wherever it is you determined it was going to be. I forgot where it's going to be. It's going to show up on the slide next, but I'll be as surprised as you are. So again, you put your order out there. Buy if it goes above 92.35. It does, you get filled, and then what you do next, you put in your stop. So at this point, you have a 1x position. Right, so you get long at 92.35. You've got your stop at 91.95. So again, you've got 40 pips of risk. Now again, what you've predetermined is, okay, my next entry is going to be at 92.75. Now, let me just say this, that I already got the question of when do I enter my second position? Well, look, you should enter the second position for the same reason you entered your first position. What was the reason? It was a high base breakout. It gave me a great charting pattern, and it gave me a clear entry point. So what is the reason to get in again? Well, it's given me another high base, and if I didn't get in it back here, I would want to get in it over here if this broke out of its high base. So the answer to the question of when do I take my second and third position, it's still off of chart setups. Once it gives you another chart setup, that's when you enter your second and third position. So you can see here, the currency goes up. We get triggered on our 2 times position at 92.75. We now have an average cost of 92.55 is going to be our average cost. So again, this is our 1x position. This is our 2x position. We have an average cost of 92.55. So again, we had a 40 pip stop on 1x position, so we want a 20 pip stop on a 2x position. That would be 92.35. So once we take that second position, what we're going to do is we're going to move up that stop. We're going to move up that stop to 92.35. Pretty easy process. Again, if you should know how to do that in the trading accounts, but if not, we've got videos that show you how to do that. And then at this point, it's just managing the position. Now, you can decide to take a third entry. I know there's a trade last month where we got into a 3x position and ended up being a very big gain. I want to say it was like 240 pips or something like that, where the market was moving enough for us to take that third position. But again, everything should be predetermined. If I predetermine that I'm going to take 2 positions, I don't take a third. Because again, that would be me feeling like changing my mind in the middle of a trade, which is usually a terrible idea. So at this point, it's just managing the trade. It's just managing the trade, and what you're going to do is you're going to move up your stop. Just like we teach you how to do, you're going to take your stop and say, okay, I'm going to move it up to the 20-period moving average. And you can see it's simply doing an ascending triangle pattern here, and really you would still be in this trade up here at 93.75. That is a 140 pip gain. That is a really nice gain on a 2x position. If you had a two lot position or 200,000 position, we're talking about 2,800 bucks. And again, our initial risk was 40 pips, 400 bucks. This is how you win in trading. You take $400 losses and you take $2,800 gains. That's how you make it in trading. And again, going back to the FXCM study, it's what most people do very poorly. I love this pyramiding strategy because it gives you a way to do exactly what you're supposed to do, is hold on to those winners, cut the losers. You're going to make 10 trades. A bunch of them aren't going to work. You're okay with that because all you need is the 1 or 2 runners. And when you get them, you pyramid into them, you make a ton of pips. It pays for all the losers and more. All right, let's just do one more setup here. All right, so again, here we have a bear rally setup. We've got a currency that has changed trends. We've got moving averages have gone down. We're now making lower lows, lower highs. We just came down, hit a low. We rallied back up and failed. So again, this is going to be entry number 1. Take a 1x position. Take a 1x position here. You put your stop wherever you predetermined your stop is going to be. It comes down, has another bounce. Well, you've said I'm going to take 3 positions on this if I can. We get another bear rally, so what do? You take your second position. Once you take your second position, you're going to move down your stop. You can see you had a big fall here, had a bounce back up. As long as you think the trend is still down, this would be a great time to take your 3x position. Again, each one of these positions was taken because of a chart pattern that it fulfilled. They were all bear rallies. Now, sometimes you get bear rallies and then you get bases. And then again, if you said I'm going to take a 4th position when it breaks at the low of this base, that's what you do. But as you can see in this trade, it looks like it did not break down off that base. So again, we had entry 1, 2, and 3. We had an average cost of $46.50. If we were following this moving average down with our trailing stop, we got stopped out at about 45.90. All right, so 45.90, that is a plus 60 pip gain, but it was on a 3 times position. So again, if you were in, if you're doing 1 lot position sizes, that'd be 1,800 bucks. And again, our initial risk was probably around 200 bucks. $250 was probably our initial risk. All right, this strategy is fantastic, but I want to go through and just make sure everyone understands kind of the basics of it. You have to predetermine that you're going to do pyramiding on a trade. And the way we decide whether or not we're going to do pyramiding on a trade is, number one, is there going to be a big enough move? Again, we've got to get a big move in order for this pyramiding to work. Number two, do we have enough time? Now, what I mean by time is that I have a rule that I don't hold trades over the weekend. So if I get this move on Friday, I cannot pyramid. I cannot pyramid on Friday. But if I get this move on Monday, then I can say, oh, I can totally pyramid this position because I have 4 to 5 days for this trade to work in my favor. You will take your first position off of a chart pattern. You'll take your second position off of a chart pattern. You'll take your third position off of a chart pattern. Everything needs to be done by charting, by setups. Now, there have been times where I have planned to take a second position. But like in this example, let's just say that once I took my first position, it just tanked and fell. And it never gave me a chart pattern to get in. Well, boo-hoo, I'm only going to make money off a one-time position. Everything has to be off of chart patterns to get in. So the reason you took your first one should be the same reason you took your second and third. Again, it could be bases, it could be triangles, it could be rallies, but it's got to be some sort of chart pattern. And then again, every time you take a new position, you have to adjust your stop. You have to adjust your stop to either break even or to an amount no larger than your initial risk. So on each position you take, you're going to adjust your stop accordingly to make sure you're not risking too much. Now understand, when you do this strategy, there's going to be times, and again, this is what I call it, I build a trade, and then just like on the craps board, someone rolls a 7, the trend turns around and I end up breaking even. There's been a lot of times where I built a 2 times, a 3 time, a 4 time position, and I ended up breaking even. Now, if you don't understand the big picture, that's going to be frustrating because you would have had a profit through the whole thing, and you would say, oh, I did all that work, I did it for 2 to 3 days, and it turned around and I just broke even on it. If you don't have the idea of the long-term picture of this, that's not going to sit well with you. But let me tell you what does help when you do get that one that goes for you, and you build the trade over 1 day, 2 days, 3 days, 4 days, and it keeps going, and you make thousands and thousands of dollars, trust me, it's going to make your next one a little bit easier to sit through. Now, I want to tell you a quick little story of one of my best personal trades, and it was in 2008. So the market was absolutely crumbling. This was when the fall of 2008. This is when banks were going out of business overnight. It was crazy, and the yen was a very popular trade for safety. And things like the Aussie, the CAD, and the Kiwi were just getting hammered. Just to give you an example, the Aussie yen pair went from 110 down to 55. It lost half of its value. A currency lost half of its value in a matter of 2 months. That's absolutely insane. Now again, we saw the stock market lose half of its value in a short period of time. It was really crazy volatility. And I saw the Aussie yen was moving lower, so I started pyramiding, and I ended up building up to about a 4 times position. And then some news came out, and the Aussie yen dropped another 300 or 400 pips. And I want to say I made 450 pips on it, on a FOREX position, on a 4 times position. It ended up being in the 6 figures, in the nice 6 figures. It was awesome. It was awesome. I loved it. And this is where I really fell in love with the strategy, but I've definitely learned over the years that it's not a tool that can be taken out all the time. It needs to be reserved for when there's volatility. When there's volatility, you take it out, it's fantastic. And like I said, you're going to have some where you build the trade, and then they fizzle out. You need to be okay with that. So again, we want to make sure that you understand we only do this with long, sustained moves. If it's really choppy, it's going to come down and stop you out. It's going to come down and stop you out, and then it'll maybe go your way or go against you, but you won't be in it anymore. We need long, sustained moves. So if you pull up any charts, look at something like the euro. Has the euro been in a trend where it's just gone up every day for 7 or 8 days? That's the time for the strategy when you're seeing these big moves. It's also really, really good to use these going into an earnings report. The first strategy I gave you was that you took a half position. And sometimes we take a half position off. You get into a full position, it's to your target point, you want to sell, but you think there could be more, take a half position off. Leave the other half and manage it. We can do the exact opposite on the entry. I want to get into something, I want to have a lot of room for it to move around because I think there's going to be some volatility. Let me take a half position. Once it gets to a certain point, let me take the rest of the position and I will follow the trade from there. So again, it's a great way to, if you want to make a trade but you think your stop's going to be too tight, then you just do a 2-stage entry or a 3-stage entry, whatever you want. And again, it allows you to have those larger stops. If any of you have traded news announcements, you know that there can be some pretty wild movement. And then after a couple of seconds, then the real trend shows up. And I always say it's very tough to trade those announcements. So if there's a currency at 110, news comes out on it. Let's say that we've got half the people that bought at 110 and they've got their stop at 109.60. And then the other half of the people shorted it and they've got their stops at 110.40. And what happens is the news announcement comes out, it tanks all the way down to 109.50, and this happens all the time. And then it takes off all the way up to 110.50, and then it turns back down and actually goes all the way down to 108. This happened within the matter of minutes. But if you could see, everyone got stopped out. The longs got stopped out for a loss, the shorts got stopped out for a loss. The shorts were right. It eventually went down, but they all got stopped out because their stops were too tight. If you took a half a position short at 110, and instead of a stop at 110.40, your stop was at 110.80, you could see that it didn't go up to your stop. You're still in the trade, and then when it started to go your way, you're able to add your half position on wherever you decided. It's a great way to avoid that volatility, to put it on around a major news announcement. All right, let's kind of wrap this up here. Again, hopefully you enjoyed this. My advice is test this out. Test this out on the simulator. Test this out in a demo account. Play around with it. I'm telling you, you're going to find this really. Not only is it a great strategy, it puts you in the right mindset. Puts you in the right mindset that, hey, I want my winners to be big and my losers to be small. Now, we are all born with the opposite mindset, that we want to make some money that we can hold in our hand to where it's ours or no one can take it, and we don't want to lose money. That's going to get us to sell too early and hold losers. I love the strategy because it just gets you thinking, hey, if I'm in a position that's going my way, I want to put more money in it. One of the things I've always said to our traders is the best way to know if you're in a good trade is if it's going your way. And you've done enough trades to where you say, yeah, I bought this one and it went for me, and it was a great trade. And I bought this one and it went against me from the second I bought it. Now, yes, sometimes they can reverse a little bit, but for the most part, if you bought something and it's gone against you in the first 30 minutes, you're probably going to get stopped out. I'm just saying. That's just the reality of it. Yes, some of them will turn around, but for the most part, you're going to get knocked out. And if it goes for you, hey, guess what? You at least know you're in the right spot at the right time. Will it keep going? The market will show you. But that's a great way to know whether or not you're in the right position. Do you have a profit? Is it going your way? So hopefully you enjoyed this. Everyone practice it out. Go into your simulator accounts, demo accounts. Play around with this, play around with 1-stage entries, 2-stage entries, 3-stage entries, see what you're comfortable with and see what kind of moves you need in order to get this to work. All right, thanks for joining me. Goodbye, everyone. All right, one question came in, and I really want to cover this because this is a great question. And the question is, okay, I've got a position in a currency pair. So let's say that you have a position in long in Aussie dollar. All right, so you're long in Aussie dollar, and you've legged into a 1x position, and it's going your way. The Aussie is very strong. The Aussie is very strong. Well, you want to double up on the Aussie, but maybe you're not too sure about the US dollar. Can you take a second position in another Aussie pair? Maybe you take a position in Aussie yen. The answer is absolutely yes. Now look, of course these pairs are going to act a little differently. Again, they're both Aussie crosses, but it's against the dollar and the yen. So if the yen ends up being weaker than the dollar, the Aussie yen will go up a little bit more. And again, if you want to take a third position, could you do something like the Aussie Kiwi? Sure. So you don't have to put it in the exact same pairing. You can actually spread this across. And I do this sometimes when I'm not totally sure, like I have an outlook that, hey, I want to be long Aussie, but I don't really know what I want to be short. I think it could be one or two of these. I can split these up. I can take one question, I can take one position or half a position on one currency pair with the Aussie in it and the other half position in the other pair. So that's a great question. We can absolutely do this because really your call was I want to be long the Aussie dollar against a currency of safety. So again, it's a great question. Absolutely great question. All right, hey, thanks for joining me.